Welcome to the new Barbarians Podcast. Today is February 3rd, Monday, February 3rd, 2025. We had an interesting week as usual, and we'll let Mark take us off and tell us about that. Why don't you go ahead, Mark?
Yeah, Bill, interesting is one word. It was, I love Dickens because he was a man of not just many words, but also of tautologies. It was a Friday that looked great. We ended January. I don't know if, Chris, you can pull up one of those asset class performance charts that looked okay, man. We had, a little volatility, and we'll go into what happened last week, which I think is the story. But I think everyone's still looking at Trump tariffs and what they did to equities this morning. Futures ended up opening up down 1.5%, down 2%, 2.5% in the Nikkei. But let's start with the fun stuff. Let's start with nice times. Friday ended January. By the way, as a former risk manager and a markets guy, I love when a month ends on a Friday. You have the weekend to look through the full month's numbers and digest it. And I thought I had some time, but unfortunately we didn't, because Trump enacted something on a scale that I will say we haven't seen since Smoot-Hawley back in 1930. So back to January. January ended up being a pretty neat, that's year-to-date, month-to-date numbers there, where you're looking at a pretty nice month for Bitcoin, up 9%, as high as 13% before pulling back on Friday. Gold, up 6%. And for most people, obviously, Bitcoin isn't as familiar, but gold is. Gold has not had this type of annual run since the 1970s. And I hammer that point because the reason gold was up more than equities in 1979, the last time we've seen this, equities over the last year, NASDAQ, S&P, you choose it, are only up high 20s. The last time gold's outperformed was in the 70s because of inflation. In the 1970s, from 71 to 79, gold grew in price by over 1,400%, 14x. That's the kind of returns people like to get in private equity. You had it in gold, you had it in oil. Because Nixon broke the peg to gold in 71, we funded a war that we couldn't afford, our deficit grew. Sound familiar? It's exactly what's happening now. We funded a COVID war, a war on a global pandemic. It cost us $6 trillion. Inflation ensued, deficits grew, gold expanded. So that was January. But as the chart shows you, that dynamic soon rolled over. You had oil rolling down as people got nervous about the growth prospects, as tariffs might be, sapping trade and commerce and consumption, adding taxes to consumers and confusing industry and maybe investment. And certainly those 5-day and 1-day moves show that. Equities down, oil down, Bitcoin down. Chris, can you roll to the next graph? Because we're focusing on safe harbors and havens like gold, and we think Bitcoin, more nuanced, we'll touch on that. But there was another one. The world has grown accustomed to buying mega cap, Magnificent Seven names like Amazon, Nvidia, obviously up 500% over a year and a half or so. But look what's happened with the sleepy European index, the Stoxx 50, which is a weighted index of the broader Stoxx 600.
Mark, did you double check those numbers? Are you sure that's right? That's really bad for my outlooks on equities this year.
Why is that?
Well, Europe's supposed to be sleepy, and we're supposed to, maybe move into quality, but still, focus on growth in the US. But 8.2% in a month, that's got to be, I'll do my quant thing and see how many standard deviations that is, but that's incredible.
It's unusual, you're right. And in your outlook, if memory serves, going back to what Wall Street said about U.S. equities in particular, is that they were getting it from, is that earnings that they expected maybe to get a 6,600 S&P as earnings expanded and not PEs in 25?
That is correct. We, recognize that valuations are extended historically. So to make up for that, we were expecting earnings to normalize the PE a bit.
Well, I think your outlook then supports this narrative because PEs are not quite half, but almost like 13 versus 22 in the US, 13 in Europe on the Stocks 50. And maybe people decided, investors decided to dive into that lower multiple and certainly lower earnings hideout, more risk averse and risk seeking is how I would account for this type of move. Yeah, but we've never seen it. I mean, stocks up 8.2%. I think it's the most underreported story on the street. But it is only 4.4 trillion. It's a smaller market, doesn't take a lot to move. So, maybe people are saying, are thinking that as well. I don't know if you have any thoughts on how your factors like quality versus growth in Europe versus the S&P, what that means about people weighing those two factors, growth and quality, which obviously are two big performers over the last 3-4 years.
So I think the real thesis globally is that quality is one way to sort of risk manage the momentum, and growth and momentum have been the hottest thing in the US, especially Mag 7. So, the idea is if you buy more quality stocks, you can control for that a bit as people, get a little bit more rational with their investments. But that looks like a value trade in Europe, which, value always bounces back, but it wasn't really forecasted as the place to be this year, and I'll get to it in a little while, but I just did some research in India, and most of the outlook there is also momentum, quality, control for the risk of momentum a little bit with low vol, but value just isn't what anyone's focused on right now, and that's a very interesting first month to be pretty contrarian with the consensus.
Yeah. To your point about, I think you said growth and momentum were drivers of performance, or was there another metric, or was it quality and
quality and momentum? At least in what I've just looked at with India.
Okay, so momentum for sure, and I guess what the thesis of a Substack I'm about to put out this morning, and it was so complex, I just kept trying to break it down. Ahead of this call, we said, let's lay our notes out. And I said, all right, let's just look at January versus, today, like just how the shift happened. So I think that, and the market obviously thinks, given the flow into Europe, that momentum may be an underperforming factor in 25. And I think that's going to be the case for an unless we'll touch on in a second. Sticking to like January was really clear on what happened. Good for everybody, but really good for safer havens like Stocks 50, gold, and Bitcoin. Bitcoin did sell off with the rest of crypto, but a lot less. So safer havens were good. General equities was good. That stopped with this fog of war with Trump. Now, we think that this is a symptom. And we use last week's developments to really frame this argument that we have, that debt deficits and demographics continue to be the thief of growth and value, and that unless that's addressed, you're really going to have problems. Debt deficits and demographics. So let's look at last week. We started with DeepSeek, like a deep-seeking missile, heat-seeking missile, sinking NVIDIA down 18%, hands in the air, everyone's scared, our darling NVIDIA's down. Then at the end of the week, we have Trump saying 25% on our NAFTA trading partners, a partnership that has definitely benefited us and maybe others. So everyone's like, what is going on here? And what does it mean for electricity from Canada, goods from Mexico? We understand we don't want drugs coming in, but can we handle that another way from Mexico? So all this is leading to uncertainty. We know when uncertainty happens, people cleave inward and go into the corner and suck their thumb. Less consumption, less growth, market negative, no momentum. So that was the bookend of the weekend. But we think that's noise. We think the middle of the week is where the value was. Both the US and Europe had lower GDP prints on Wednesday. PCE was still persistently high at 2.5%. We think it's still under states inflation. And more importantly, the Fed chairman, I don't know if it's the first time, but I think it is, said crypto and banks in the same sentence, as certainly they can trade custody and foster crypto trading at banks. And that legislation is needed to make that happen. He says that because he knows growth opportunities in the US are few and far between. And then secondarily, and here's where the momentum trade picks back in, Bill, I would pick it back up. I told you. Momentum trade only comes back in. We're going to have a growth hit, I believe, in Q1. We're going to have a market hit because of the negotiations. Will probably take longer than not because of fallout from tariffs. But Jay Powell had a disclaimer that was bigger than what Apple makes you sign when you get on any of their devices or any of their social media platforms as they steal your data. It was saying, hey, listen, we're going to stick to what we knew because we know what we're doing, and we're going to stick to it unless things change. A certain day ends with the word DAY, and if there's a financial disruption in the marketplace. So they're already paving the way for them to step in and say, hey, listen, we love 2.5 PCE. We're targeting 2% inflation, but we're going to have a banking issue. There's going to be fallout in the market system, whether it be from the interest expense that's that's going up 25% this year, causing a strain on debt issuance. So we think there's going to be a disruption like we had in March of 23. We think the Fed recognizes that. They're giving themselves an out. And then they said, we think digital assets belong in banks, and we hope legislation happens. The signal's clear, guys, and I definitely I'll finish up here. But all we look at is DeepSeek hitting NVIDIA and tariffs driving markets lower this morning. We're not looking at where the signal is. The signal is everyone's investing in digital assets because we're in a new paradigm where debt is requiring us to be more productive, and old games don't work. So I'll stop there. As you can tell, it's hard to. That's why it took me 3 days to write the Substack, because it's thick. It's thick with ideas, and trying to make it clear is hard.
Thank you, Mark. I'm not really sure how much we were able to cover what happened last night. When we picked up on futures selling off quite a bit in the crypto space, but it looked like they were mostly catching up with earlier losses in the spot market. So again, the digital asset market is an interesting because it is 24/7, and a lot of that bounced back. And if you weren't watching on a Sunday night at 8:00, you missed it. So that just continues to be an interesting place to be.
We'll talk about that because, people don't know, and we can, share. We were on a thread. I don't think any of us expected it, but we're kind of watching markets. And then I think Chris was the first one to point it out. But what happened in that 18-minute period? I mean, in case people aren't watching as close as we are.
So multiple assets, and so Bitcoin was kind of a leader. I'm not sure if it was down 20% or not, but several of the altcoins, including Ethereum, were down 20. I think Ethereum was down 28%, and then the riskier altcoins were down 40, and within a 18-minute period, a lot of those losses were erased. So Ethereum went up 21%. I believe we looked at the chart. XRP, which is a relatively safer altcoin, went up, I think, 30% in that 20 minutes. So, it's a wild ride. It's a roller coaster. And, hopefully if you're just long these assets, you didn't watch, right? So you kind of write it down and write it up and don't even know. Thank you for bringing up that chart, Chris. Until now, you just never saw this type of activity. And ideally, I'm not going to be trading on technicals anyway, given what I do is, more of a fundamental research analyst. But, I can understand why people sit around on their couch playing with their phone and trading on Coinbase, because it's worthwhile to keep an eye on things if that is what you like to do.
And there's an opportunity. I mean, you couldn't trade futures because they were closed, prior to that. I mean, I think futures opened up soon after. Well, I mean, and Bill, we're talking about market caps of, between 150 to 300 billion for some of the altcoins to $2 trillion for Bitcoin. These are not, the NFTs that, people are talking about on Twitter. These are assets, especially Bitcoin, as you said, Bitcoin is now down 4%, Ethereum's down 16%, XRP 20% over the last 24 hours. And equities are only down, 1.5%, 2%. So, people are like, God, thank God I'm not trading in these things. But I implore people to take a look, because Jay Powell is inviting banks, which he's in charge of. People think FDIC is, and no, Jay Powell is. It's his loose confederation of 4,000 banks that he runs. And he's saying, get this stuff on there because we need new revenue. As that happens, guess what happens to volatility and variation? It's going to decline. What happens to market value? It's going higher.
Yeah, I agree. And I mentioned XRP. It seems like that's one of the leaders in the interbank crypto transfer space.
As a Bitcoiner, we're going to go back and forth on that one, but that's for another episode about the XRP army. But certainly, it has gotten a bid, as you mentioned.
So, as always, we'll try and not focus too much on crypto in this podcast. I did want to just go over a few things that are coming up. Unfortunately, I did not release my research paper on SSRN, but I am wrapping up a portfolio construction / optimization paper that goes into some advanced techniques, in particular with the optimization process. And, as I'll cover in the paper, there are, generally two ways to construct a portfolio in the quant space. One is you can, release what are, generally referred to as models that are, sector specific or strategy specific, and then sort of bifurcate some of your signals a priori, so up front before you actually release them. Or you can come up with a bunch of signals, put them all into the same sausage maker, and sort of diversify your portfolio after the fact. And when you do the former, there's an advantage because, there's a diversification among your strategies that's inherent in the way you constructed the portfolio. You have a model for, European equities. You have a different model for US. So those should be, by design, uncorrelated, or at least less correlated. You have sector specific models, maybe being the easiest example. But when you build what's called a cross-sectional portfolio across all of the stocks you trade, you basically achieve diversification by looking at everything at the same time. So you basically put all your stocks into one portfolio, you do a mean variance optimization, and sort of get the diversification on that last step. The disadvantage of doing that is you can lose some of the signal from those like for example, sector-specific strategies. So for people that are into this and enjoy all that gobbledygook I just blurbed, the research paper that I'm going to publish on SSR and goes into pretty deep dive on things like hierarchical risk parity, which is fairly well known, but basically you can start to group different signals and strategies after the fact and gain some diversification. You can monetize some more signals and use some machine learning to achieve a little bit of that former portfolio construction as well. So hopefully everyone can look forward to that. And if you do look forward to that, I also plan to release a podcast on the topic that will be two different hosts. It will be a man and a woman discussing advanced portfolio construction and optimization.
What are their names? Because I'd love to look up their history, Bill, and see what other shows they've been on.
But they actually don't introduce themselves by name because they are, they're not exactly friends of mine, but they've been pretty good at interpreting all of my research and concisely summarizing it into a 20-minute discussion because they're Google robots. And I think I did mention this previously when we had Tharsis on. I'm using Notebook LM. I basically just uploaded my paper. It's a fairly in-depth PDF document, and I was impressed with what they came up with to talk about it. At times it can sound a little corny, but they definitely did a great job. So our listeners can look forward to a robotic discussion between them.
That's fascinating.
I guess it's a man and a woman, at least a man's voice and a woman's voice, or I should say, yeah.
Yeah, and
I don't want to get into gender.
And we have to qualify everything, right? So maybe we should give them some images. Back to your factor, when you're talking about the gobbledygook, what I like about factors, I came from the fundamental world and then worked with factors at hedge funds and then later as a strategist at Credit Suisse. And it's just a different lens. It's just looking at the world, instead of saying that something is, I'm trying to think of forget the analogy. It's looking at the world through a different lens. And given that what we saw with returns with gold and oil having good Januaries and commodities really kind of leading the charge, is that a factor in your assessment? How would commodities in general be there? Would that be value, or what would it appear as?
So good question. There are typically sectors that align with factors, and depending on where you are in a cycle, where so the commodity cycle right now, I think a lot of energy stocks are decent value plays. So given the decrease in the price of oil, their PEs are not stretched the way they are in tech, for example. So that I think typically will be an example for a value play when you see.
Got it. Got it.
I guess different drivers of valuation for sectors, kind of move together. So I believe the answer to that is yes. But
so someone would look at it and say, "Hey, I love commodity related currencies, whether it be one of the Nordic countries or Colombia, who has North Sea oil, or Colombia has oil as well, or I forgot another commodity generated currency, or even oil in general." You would say, well, they would look at it, since oil companies tend to have lower PEs, lower multiples. They don't look at it as a commodity. They just say it's a value play. And so there may be other ones, but that commodity play will be grouped in maybe with a retailer because it's a low PE value play, or I'm trying to think of, other value entities, industrial or something like that.
Yes, and so this does also get into, generally speaking, my own research that I do on markets is I like to bifurcate things and to sort of trade the dimensionality between regions, sectors, and risk premia. And what's interesting is you're describing when you have overlap among many of them. So if you like a certain region, a certain sector, and a particular risk premia, you should focus on those and sell the ones you don't like. Which also brings up another topic that I'm just diving into recently, which is the stock market in India. I've been doing some research, some factor research in India, and it does cover this exact concept where, there are multiple outlooks on the region, the sectors within it, and then risk premia. And, even getting back to the earlier thing we said about momentum and quality, I think that is, a focus there. And you have a lot of risk in emerging markets. A lot of people think of those as risk on trades, but there are definitely pockets of every market that are, less risky. And just given what's been happening recently and what, that chart you showed me about Europe, I honestly did not realize that it was that pronounced. I may have to revisit some of my assumptions, but that is actually consistent with my outlook in India, for example, where, people will seek quality as a hedge for the extra risks they're taking with, going long emerging markets. And I think I can weave my way into explaining that a little bit better. But and then I do have a research agenda for the rest of the year, and February is going to be crypto month, and next week we are bringing a guest back in. Well, not back in, it'll be another guest on our podcast. His name is Connor Farley. He's the CEO and co-founder of a firm called Truvius, which is a quantitative crypto investment company. And so they more or less they're like managed accounts, but they, I believe, are a registered. I don't want to actually opine on exactly what their regulatory framework is, but they have investors that want to gain exposure to the crypto space, but they want someone else to sort of manage the risk and portfolio allocation, and they're doing it in a quantitative way.
And Bill, like most people, he didn't start in that space, right? I mean,
no. Connor actually was an intern with me at AQR. Gosh, that's probably about, I don't want to say it's 10 years ago because I'm not sure exactly how old he is, but no, he went off and started that company, I believe, 4 years ago.
Yep.
But yes, he did start as a intern researching equities at AQR.
Yeah, and that's what the reason we bring that up is because, like Jay Powell saying, banks are going to get into crypto. We think Bitcoin first, but definitely trading crypto and all of these protocols is because that's where the opportunity is. And guys like Connor are doing it. You, me, Chris, people who've come from traditional markets, know what the direction of travel is. And so, I'm looking forward to getting Connor on. And if no one's listened to our last podcast with Tharsis, it is a must. He goes through the use and impact of AI that I think I've not heard it done clearer. And, what Bill said about our, faceless podcast hosts that are going to be launching into his most recent writing, the tools and uses are still being developed. I look forward to having Connor on since he's been on both sides of the financial river, trad and digital.
Yeah, and I think the fact that he's a human keeping an eye on these things is a good option because, when we had Tharsis on, we did talk about how robots are taking over, and now we have these two co-hosts that are going to do a better job than I can talking about my paper. And, there's still a need for us, Mark.
Yeah.
Especially old timers that know a lot about what happened in the past. It's important.
Yeah, they're going to stick us up in the balcony like in the Muppets and just have us comment on everybody, I think, soon enough. But that's all right.
But you can't make Muppet references. No one knows what those are, right? Well, yeah, we have our audience. They still know what the Muppets are.
Yeah.
And then last but not least, certainly not least, Chris is going to release an Ethereum paper this week. And I love when Chris does these primers because, as a newcomer to the space, I need to educate myself about the fundamentals around the crypto ecosystem. So I learned about levels with one of his first papers, and I've mentioned this before on this podcast that Ethereum was the first, other than Bitcoin, again, that's a microeconomic story, but Ethereum was one of the first like altcoins that I really became attracted to because of this thing called the smart contract. And, I don't know, Chris, if you want to do a better job of summarizing that in, a 30-second clip.
Yeah, for sure. The paper really concentrates on breaking down Ethereum, its value proposition, and kind of the recent shift that's happened in this space where it made a decision a couple years ago to, rather than scale its L1, to allow L2s to build on top of it. So it made way for cryptocurrency blockchains like Arbitrum and others to build on top, and then also created an ecosystem where there's competing L1s. So I kind of break down that ecosystem, Ethereum's dominance, and since losing a lot of its market share, what that means for it in the future, for TradFi adoption, competing L1s, and then supplemental L2s. So going to break down all of that based upon the tokenomics and metrics that we use in the crypto space, and kind of relate that to traditional finance metrics. And then in a part two, I'm going to put together a portfolio construction based upon how risky these assets are, where you should be putting your money, and kind of break down a portfolio construction. So really looking forward to getting that out.
Cool. Thank you, Chris. And I believe we are going to do our best to, stay on a better timeline. So is that about all for today, Mark?
That's it. I think we've done weekly to date, so I think we are doing it, and we're trying to keep it tight here. Definitely inside an hour. We'll chop it up, but we do want to make sure that you look at, Bill, please tell us where you can get the work that you and Chris are doing on AI and crypto, and I'll do the same.
Cool. Yeah. So we're going to be on SSRN, Substack. I also have a website called harmonicinsights.com where I publish a lot of this. And then, we're going to have these robotic podcasts, including one on crypto later on this month. But keep an eye out for the one on portfolio construction like this week.
Perfect. I do suggest it. And if you haven't read the Harmonic Insights piece on LLMs, you're playing with one arm behind your back. Please do that. And then I'm on Substack, Mark R. Connors. Everything I have there. You currently have access to everything. I'll be going to a paid model this quarter and tiering it. But I hope you find it valuable because I do bring you into why Bitcoin now early and often, so that it's accessible to the layperson and professional alike.
Cool. Last but not least, please subscribe to the podcast on your favorite venue. Like, comment. We really welcome interacting with our audience, and we love when you reach out on LinkedIn or wherever you want to. We will respond and hopefully address any questions you might have on the podcast.
Well done. All right, folks. Until next week. Adios.